Every single day, millions of people swipe, tap, or insert a small piece of plastic into a machine without giving it a second thought. It is the debit card, a financial tool marketed as the ultimate symbol of convenience, safety, and modern monetary progress. We are told it is the safest way to access our hard-earned money. But what if that convenience is actually an illusion? What if the very mechanism designed to protect your wealth is silently exposing you to severe financial vulnerability, leaving your entire bank account defenseless against modern threats? Imagine waking up to find your account completely drained, your rent money gone, and your bills bouncing, only to realize the system you trusted has left you stranded for weeks while an investigation crawls forward. This is not a hypothetical scenario. It is a systemic reality built into the architecture of modern banking. There is a fundamental flaw in how the debit card connects you to your capital, a flaw that disappears entirely when you shift to a far more strategic alternative. Why did I completely stop using my debit card, and what did I replace it with to achieve true financial security and leverage? The answer rewrites everything you've been told about personal finance. To understand why the debit card is a flawed instrument, one must look at the evolution of modern commerce and transaction security. In the early days of banking, transactions relied heavily on physical currency, ledger entries, and manual verification. As the global economy expanded, the need for efficiency birthed the modern electronic payment network. First came the credit system, designed to facilitate delayed settlements, followed closely by the debit card, which allowed users to access their personal depository accounts instantaneously via automated teller machines and point-of-sale terminals. The debit card was championed as a revolutionary tool for personal budgeting, allowing users to spend only what they possessed. However, this direct link to a user's liquid capital created an unprecedented structural risk. By analyzing the mechanics of payment networks, consumer protection laws, and institutional liability, it becomes evident that using a debit card for daily transactions is a high-risk financial strategy. Understanding this shift is not merely about choosing a different piece of plastic. It's about mastering the rules of the financial system to protect your wealth, maximize your cash flow, and navigate modern commerce with absolute security. The structural vulnerability of direct access. The primary flaw of the debit card lies in its direct architecture. When you utilize a debit card, you are utilizing a direct digital pipe into your primary checking or savings account. The moment that card is swiped at a terminal, entered into an online checkout page, or inserted into a compromised fuel pump reader, that pipe is exposed to the outside world. From a technical standpoint, a debit transaction initiates an immediate ACH, or real-time network settlement. The money moves instantly out of your possession and into the merchant's account. If a malicious actor intercepts those card details through a skimming device or a database breach, they don't just steal a line of credit, they take your actual liquid cash. The psychological comfort of only spending what I have blinds consumers to the stark operational reality. With a debit card, your actual money is on the front lines of every single transaction. If a fraudulent charge occurs, your account balance drops immediately to zero. The burden of proof falls entirely on you to convince the banking institution that a crime committed, leaving you financially paralyzed during the interim. The legal disparity in liability protection. To truly comprehend the risk, one must analyze the legal framework governing electronic fund transfers. In many jurisdictions, credit cards and debit cards are governed by entirely different sets of laws, resulting in a massive disparity in consumer protection. Under standard banking regulations, if you report debit card fraud within a strict window, the bank is required to investigate, but they have a significant legal time frame to do so, often extending from 10 to 45 days. During this period, your money remains missing. Conversely, credit cards operate under alternative regulatory statutes that limit user liability significantly. When a credit card is compromised, the money stolen belongs to the bank, not to you. The fraudulent charge sits on a line of credit, meaning your personal cash remains entirely safe, insulated within your bank account. You aren't fighting to get your money back. The bank is fighting to get their money back. The institutional motivation to resolve the issue is fundamentally accelerated when their own capital is at stake. The myth of convenience and the opportunity cost. Beyond the immediate security risks, the debit card fails as an optimized financial tool due to its complete lack of leverage and opportunity cost. When you use a debit card, you receive zero financial utility beyond the simple execution of the transaction. You swap hard currency for goods, and the relationship ends there. By completely halting the use of a debit card, an individual unlocks access to institutional capital efficiency. The alternative approach involves utilizing a structured credit instrument or a cash-backed ecosystem as a buffer. By funneling daily expenses through a secure, non-direct payment method, you keep your actual capital resting undisturbed in high-yield vehicles, earning interest until the precise moment of settlement. Furthermore, debit card users are entirely excluded from the ancillary benefits provided by payment networks. These benefits include extended product warranties, purchase protection policies, trip cancellation insurance, and robust cashback or travel rewards ecosystems. By using a debit card, you pay the same inflated prices at the counter, prices that merchants raise to absorb network processing fees, without clawing back any of those fees in the form of rewards or protections. You're effectively subsidizing the rewards of consumers who refuse to use debit cards. The transition to the buffer system. The decision to discard the debit card requires a tactical replacement strategy. This strategy is known as the buffer system. Instead of allowing the world direct access to your liquid assets, you construct an impenetrable layer of separation between your liquid assets and the marketplace. Visual cue, an analytical flowchart demonstrating the flow of income directly into a high-yield storage account, while daily expenses flow through an isolated credit or charge layer that is paid off in full at the month's end. In this system, the debit card is locked away in a secure location, utilized exclusively at highly secure physical bank ATM locations if and only if physical cash is absolutely required. For all daily commerce, online transactions, recurring bills, and subscription models, an isolated credit or charge card is utilized. Every transaction hits this secondary layer. At the end of the billing cycle, the accumulated balance is paid in full via an automated transfer from the primary account. This ensures that you never incur a single cent of interest or debt, maintaining absolute financial discipline while ensuring your primary depository account remains completely invisible to the merchants, terminals, and hackers of the world. The day that the shield was validated. The true validation of abandoning the debit card occurs when the system inevitably faces a breach. Consider the profound shift in dynamics during a major data compromise. A consumer relying on a debit card wakes up to an empty bank account. The mortgage payment is rejected, utility accounts face cancellation fees, and the individual experiences acute emotional and logistical distress as they plead with bank customer service representatives to expedite a fraud claim. Now, consider the individual using the buffer system. A notification flashes across their screen indicating an unauthorized $5,000 charge at a luxury retail outlet thousands of miles away. With a calm, calculated sequence of clicks, the user marks the transaction as fraudulent. The credit issuer immediately cancels the compromised card, reverses the pending charge, and dispatches an overnight replacement. Throughout this entire sequence, the user's actual money never moved. Their rent was paid on time, their savings continued to accrue interest, and their daily life proceeded entirely uninterrupted. The systemic crisis was reduced to a minor logistical footnote because their liquid wealth was shielded behind institutional capital. This is the moment where theory becomes reality. You realize that protecting your wealth is not about trusting the network, it's about controlling the interface. The complete cessation of debit card usage is not a mere preference. It is a fundamental acknowledgement of how modern financial architecture operates. The system is inherently asymmetric, and those who do not understand its mechanics will always bear the highest burden of risk. Relying on a debit card means voluntarily exposing your foundational assets to an increasingly volatile digital landscape. By implementing a strict strategy of separation, relegating the debit card to secure asset management, and utilizing insulated channels for daily commerce, you reclaim control over your financial security. You eliminate the risk of catastrophic account depletion, shield your household from structural banking delays, and optimize every dollar through network rewards and legal protections. True financial discipline is not about restricting yourself to a primitive tool. It's about leveraging advanced tools with absolute precision and responsibility. Lock away the debit card, construct your operational buffer, and ensure that your hard-earned wealth remains exactly where it belongs, entirely under your protection.